Joining us now on Business Now, June Liu, the lead portfolio manager for Tribeca Investments Alpha Plus Fund. June, I spotted an opinion piece you wrote in the Financial Review earlier this week saying equity markets right now are sort of at a crossroad. It's a crossroad of fear and uncertainty, you called it, caused by the prospect of rising interest rates, among other things. So, I just wondered in your crossroads, where's hope and optimism?
Look, hope and optimism is coming now when we actually see the corporate earnings. Last month, everyone was fearful the result will be terrible and the interest rate will be so much higher than what we expected, and which in turn will defer sort of economic recovery. And so hence we saw the share market down a lot in January. And now heading into the reporting season, we actually think things looking pretty good, not just for this reporting season, but for the next 12 months. Corporate earning is going to grow double digits, taking out the mining resources, and the dividend yield, the dividend they pay back to shareholder, will be hitting high single digit. That's a lot of return back to the investors, back to the share market. And this is not to mention that, all the mergers and acquisitions will continue to take place, which will continue to drive the share market. So, with the market correction in January, everything actually is looking pretty good heading to the reporting season.
All right, so you heard from Anthony Scali there, and that's a type of company that could have potentially been hammered on the market today if they'd come out with the wrong message about supply chains and whatever. In actual fact, the shares were up. It was a pretty good outlook from them, and it really was. So again, this is the type of story where, again, the messaging has got to be right and the circumstances have got to be right for these companies if they are to get through this unscathed.
Absolutely. One of the biggest fear heading into this reporting season is this supply chain disruption. We all know lots of people have been affected in the workforce, couldn't get to the job and put product on the shelf, as well as the border closure, so we couldn't get the furniture from offshore makers into Australia. So there was a lot of fear heading into the reporting season that the retailers like Nick Scali, will be severely impacted. Look, they have been impacted, and they said next 6 months is still going to be pretty tough because, people and the border closure. But look, it's not as bad as people expected. And then in terms of demand, it's still very, very strong, even though the shoppers couldn't get to the shops. But look, the pipeline, what they intend to buy is very, very strong. So, demand is strong, consumers willing to spend. Supply side disruption, they're managing it. They're managing it really well. So, with all that together, certainly the share price being rewarded, and that is a very good surprise. And we have heard from JB Hi-Fi so far last month about things that are not too bad as we expected. So I think this reporting season, that sort of fear about supply chain disruption might be alleviated.
And one point of optimism is that these companies, it appears, are getting away with price rises that maybe 3 years ago they would not have got away with. And that's because costs are rising, but people feel affluent. They feel as though they can afford it. But that eventually is going to flow into wages. That's the whole story about the Reserve Bank and what they've been talking with inflation this week.
That's right. When the Reserve Bank talk about interest rate increase, people get scared about, how terrible it is. But remember, when the interest rate goes up, means actually economic activity is very strong. People are getting paid more. People saved a few months ago, saved 20% of our GDP, and that money needs to be spent. And they're happy to spend on things that they feel good about, which is their house and household related goods. And in the future, when the border opens, there will be travel, will be restaurants, will be all of these things. So our economic conditions very, very strong.
Okay, so Westpac is another example of this as well. Shares up 2% today. The cash earnings for the quarter, $1.58 billion, up by 1%, better than the market expected. But its margins had been squeezed from 1.99% to 1.91%. But banks are also businesses that benefit when rates rise because their margins improve.
Oh, absolutely. In 6 months' time, when the RBA do start to putting up the rates, and the bank will be a big beneficiary. Right now, the reason the margin is a bit smaller is because rates are low, and two is that there's been so much competition with all these low mortgage rates.
Hang on, can I stop you there? Did you say in 6 months' time the rates will start going up? Is that what you said?
6 to 7 months.
6 to 7 months.
6 to 7 months. It is going higher this year, but remember, don't be fearful. It's going up because we're not in, we're passing the point of pandemic where we had no vaccination, where none of these, and the interest rate is still so much lower than what it was before the pandemic. Things are good, and people have a lot of money to spend. So the interest rate do need to go higher. That is to make our economic activity more productive, and that is good for our economy.
Okay, so I want to take you right the way back to your very first answer. And a lot of people might have missed this on the way through, but it came up in your Financial Review opinion piece this week. Despite all of the headwinds, despite the crossroad worried of uncertainty and fear, all that type of thing, you still believe that the Australian equity market this year will grow in the double digits, so more than 10%, which is, in historical terms, a really good year for the stock market.
Absolutely. It'll be, we think it'll be in the low double digits. It will absolutely get there, if not exceeding it, because the dividend is simply itself will get you there, and the economic growth is actually very, very strong.
Okay, so Junbei, just the types of stocks that you think will be, outperforming this year. What types of stocks are they? Because that's an important thing, because some are clearly going to be laggards if they've got supply chain issues, but others are going to be outperforming significantly. And also some of the tech stocks, which we've seen really get washed out in this last day or so. Again, there's question marks about their valuations.
Oh, absolutely. Look, this is going to be the year about active investment. So finding companies that have real earnings drivers. Some of them might be tech stocks. SEEK, for example, is going to have amazing results. Share price being sold up because it's one of those growth companies. But this company is so linked to our economic growth. The job data month on month is delivering very strong growth, and we know they're going to have very good results. Company like that. But also this year, look, energy company will do pretty well, but that's a pretty consensus. Everyone's expecting them to do well. They're very, very cheap, but they're delivering good dividend, and they will generate very good return for investors. But our view is that this year is going to be a year where you actually find a lot of hidden gem when every other investors sort of shun them, when they stay away, sort of become fearful, like what we saw in January, and buy these stocks. So many healthcare companies being sold off. Cochlear is a company you buy, just put in your bottom drawer. Share price come off significantly because caught out in all of that. You don't even need to worry about the future growth. So some of those names, it's just an incredible buying opportunity. Once in probably every 5 years buying opportunity that you should look out for.
There you go. Junbei Liu, always great to have a chat to you, and thank you so much from Tribeca Investments. Thank you so much.